Good morning, everyone. This is Larry McMillan on Monday, March 2nd, 2020, with a report before the market opens. It was a pretty disastrous week last week for the S&P and other major indices. The selling that we've been discussing for the last 3 weeks came to fruition all at once, which sometimes can happen. This is a little bit unusual situation, and it seems to be caused more by worries about coronavirus than it is about necessarily financial things, but they're related to a certain extent. Anyway, we have massive oversold conditions all over the place, but only one buy signal, and that's really not enough to jump in wholeheartedly on the alongside, although you could test the water a little bit. The S&P chart has broken through multiple support levels. It broke through the December lows. There's an old adage that if you break through the December lows in the following year, then you're in a bear market. So a bear market means, this could last for a while. Not at this pace, hopefully, but it could last for a while. In any case, the index dropped so fast that it's well below its modified Bollinger Band. So that's an oversold condition. And there will be a buy signal eventually when it rises back above the -3 standard deviation Bollinger Band, but that could take a while. In put call ratios, the equity-only put call ratios are still on sell signals, and frankly, while there's been a lot of put buying, these ratios are not racing higher like we normally see them in this bad of a market. So by that count, there's still a ways to go. Also, the total put call ratio has registered 3 of the last 4 days greater than 1.0, meaning more puts traded overall than calls. That's very unusual, and that is another oversold condition. But right now, it's just a short-term one. For there to be an intermediate-term buy signal from the total put-call ratio, it would have to rise substantially from here. Market breadth is terrible, of course. Our breadth oscillators, the stock's only breadth oscillator is down below -1,000. It's only been there about 15 times in history, and most of those are multiple times, like several times in 2008. The bottom in 2018, the December 24th lows, it's approaching that level almost already, and that was the most oversold we'd ever seen. So breadth is not good, and it's still giving sell signals. It's really not going to reverse around to a buy signal until there's multiple days of advances leading declines, and we haven't even been close to having one of those yet. New highs are being completely decimated by new lows. That's the reverse of what we'd seen back in January, of course. And this indicator did give us a sell signal shortly before the market collapsed. So it's trustworthy, but it's very, very oversold at this point. But oversold does not mean buy. So you can't just jump into a market because it's oversold. You can get run over very easily. The one area that offers a little bit of hope right now is volatility. VIX has generated a spike peak buy signal. It rose up to 49 and then closed at 42 on Friday. So that generates a short-term buy signal. These have a good track record in general, but it's really, fighting a lot of other indicators at this point in time. The intermediate term trend of VIX, however, remains negative because both the 20-day moving average and VIX itself are above the 200-day moving average. Perhaps one of the more disconcerting things is the inverse term structure on the VIX futures and the VIX volatility indices. Again, this is an oversold condition, but I've heard commentators on TV say, "Oh, well, VIX is inverted, you can buy." That's not true. You can buy when it's been inverted and then goes back to not being inverted. That's when you would buy. So we're looking for some positive movement here, but it's going to be tough. So right now the term structure is inverted. It hasn't been this heavily inverted really probably since 2015, and that lasted a fairly short time. In 2011 it lasted for a longer time. So this is not good, but there are strategies that are built around that. and we are using those strategies in our daily newsletters and things. So visit optionstrategist.com, and you can, as a subscriber, you would, of course, be privy to those. So where do we stand overall in the market? Well, it's still bearish, but extremely oversold and extremely volatile. Even just last night, Sunday night, there's been a 130-point range on the S&P futures, and we're not even to the opening of the next day yet. So strategies that involve strictly buying options are really pretty tough right now because you're paying a lot for the options. If you buy a call and the market goes up, VIX will drop and your call will be swimming upstream, as we put it. If you buy a put and the market doesn't fall quickly, you're going to lose a lot of time value premium. So spreading techniques are appropriate now because VIX is so high. Most of the time we don't like to use spreads, but now they would make some sense. So we're certainly not turning bullish on the intermediate term at all. We have the one short-term buy signal. What we're doing with our long puts and things is rolling them down to lower strikes, or just setting a tighter trailing stop behind the index or the stock, if you're talking about individual stocks. And we're continuing to view this as an intermediate term bearish market with potential oversold conditions producing some rallies along the way. So thanks for listening, and be sure to visit optionstrategist.com.